You ready for some fun facts? Of all the homes across America, about 63% of them have mortgages on them. Between Q4 of 2021 and Q4 of 2022, those 63% of homeowners that have a mortgage have gained over $1 trillion in equity. How are they accessing that equity when they have a first mortgage that's 2.75, 3%? 3.25% interest rate without losing that great interest rate on the first mortgage? The answer is a home equity line of credit. It may be for you, it may not be. In today's video, I'm going to go over the pros and the cons of a home equity line of credit. All right, Matt, the mortgage guy, residential mortgage broker, licensed in 48 states. If you want to connect me and my team, whether you're trying to get a first mortgage, trying to get a home equity line of credit, I'm happy to help. Go to greatmortgagebroker.com, fill out the quick form, and we will talk. As always, I'm going to give you straightforward advice because a home equity line of credit isn't for everybody. And a home equity line of credit, even if it is for you, you may not be best served with the products that I've got available to me. So let's go over, first and foremost, what is a home equity line of credit? Well, like it sounds, you are borrowing against your home equity. Let's give you an example. Your home's worth $1 million. You owe $500,000. You've got $500,000 in equity. Most lenders that do home equity lines of credit will allow you to borrow up to 80%, up to 90% combined between that first mortgage of $500,000 and the home equity line that they're going to give you. So in this case, you might be able to get $300,000. That would total $800,000, 80% of the value, or $400,000 on this home equity line of credit. And just to recap that, you owe $500,000, you add a $300,000 or $400,000 home equity line of credit behind that in second position, you're now at 80% or 90% combined loan to value between your first mortgage you already have and this home equity line of credit, right? Those two debts versus the $1 million valuation. These come in all shapes and sizes. Some are fixed, some are variable, some have to be paid off within 10 years, some are stretched out over 30 years. So I'm not going to go into necessarily all the different types of home equity lines of credit and how those are structured. But what I will do is tell you some generalities, some pros and some cons, right? Because there's going to be pros and cons like any financial product. The biggest pro in the interest rate environment that we currently live in is that you're able to leave alone that first mortgage, especially if it's sub 3.5%. If you've got a $500,000 first with a 2.75 30-year fixed, I'm going to highly encourage you to leave that alone, except for in the most extreme of circumstances. Sometimes it's, you have to do a cash out refinance, whether it's, a divorce or some, massive amount of debt that needs to be consolidated. But for most people, if you're going to take $150,000, $200,000, you're going to build an ADU, you're going to invest in investment property, leave that first alone, take that home equity line of credit of $150,000 or $200,000, and it really is not going to matter if that term is 8%, 9%, 10% even. If the majority of your debt is going to stay fixed at 2.75, you're going to leave that first alone. So biggest pro is that you don't have to mess with a first mortgage that more than likely in today's environment has very, very good terms. Another advantage is, access to funds. If you have $1 million home and you have a $500,000 first, that $500,000 in equity really doesn't mean much to most people because you can't feel it, you can't touch it, you can't access it unless you do something like this home equity line of credit where you can access it. And some of them work as an open credit line. You have a $200,000 home equity line of credit, you might only borrow $100,000. You might go off and do something with that $100,000, whether it's a down payment on investment property or something else. And then later, you've paid it down to $50,000 and you've got another opportunity, but this one's going to require another $150,000. If you have a $200,000 line with a $50,000 balance, you can go out and borrow that 150 and, max out that line at 200 grand. Now, I'm not saying you should, I'm just saying it's an option, right? So access to funds is a big pro. Now let's get to the cons. There's always cons. And one of them I'm seeing that people really don't like, based on feedback I'm getting from clients, is variable interest rates. Variable interest rates scare people. With a fixed rate mortgage or home equity line of credit, you pay the same this month, next year, 5 years from now, you know what your payment's going to be. With variable interest rates, how some of these products are structured is they might have an intro rate, 4.99% for the first 6 months. And after that, it adjusts and it's variable. I get that this can be scary for people. And I agree, you should beware of a variable interest rate. It's not like it's the worst thing in the world. For some people who understand it and can benefit from the lower introductory rate or lower rate, blended for how long they're going to keep this home equity line, it could be a better thing, right? But know what you're getting into with a variable interest rate. You don't want to be in a situation where it only makes sense today, but if the rate were to go up, then you're cash flow negative on a rental property or something like that. Understand the terms of the HELOC, including how the interest rate is determined, any caps, right? Because these variable rates, you'll know, it'll say it's going to adjust every 6 months. It's going to adjust every 12 months. It's based on, this index plus 2%, based on that index plus 3%, whatever it is, know the terms. Another con is a potential for overborrowing. And, in my example, where you've got $1 million home and a $500,000 first, if a home equity line of credit company is willing to give you up to 90% combined loan to value between the first and the HELOC, doesn't mean you should, right? If you go out there and borrow that $400,000 and you borrow it on terms that are either variable interest rates or they're just terms that, you're paying interest on this money and it gets spent on maybe an investment property that doesn't make sense or the numbers make sense, or a business opportunity that might go sour, you can get yourself in a lot of trouble, right? And that leads to, con number 3, which is risk of foreclosure. Anytime you borrow money against your primary residence, and I know that there's home equity lines of credit for investment properties. For most people, it's going to be on your primary residence, so I'll speak to them. Like, borrowing more money against your primary residence comes with risk. And risk of foreclosure is one thing. In that example, where you owe 500, home equity line of credit company allows you to borrow another 400. So now you've got 900,000 in debt on this $1 million property. If that 400,000 is at 8 or 9%, or it's variable and the payment goes up, and then wherever that money got invested, let's say it's a business that didn't work out, now you're at risk of foreclosing on your primary residence. That's bad. That's a definite con. I'm not saying it's going to happen, but I'm saying beware. It's crucial to make payments on time and only borrow what you can afford to repay. That's some quick pros and cons. These home equity lines of credit are really, really popular right now. I'm seeing people win by using them. And I'm especially seeing people make smart financial decisions, which doesn't include refinancing their loan that I gave them in 2021 at 2.625, 2.875, whatever that number is. So carefully weigh the pros and the cons. Consider your financial situation. If you want to talk to a pro, we're more than happy to help. GreatMortgageBroker.com. But like most financial products, it's not a one size fits all. For some people, you only owe $82,000 on your first mortgage. You're looking to take out $250,000. You've got a great opportunity where you can build 2 ADUs that each rent for $2,200 a month. That might be a scenario where a cash out refinance makes sense. You only owe 82. Your new, mortgage with that $250,000 cash out, you're not worried about losing a great rate on $500,000 worth of a first mortgage. You only owe 82. And so maybe a cash out refinance with a fixed rate, exactly what it's going to be, is the ticket for you. But you don't know that until you talk to a pro who's able to kind of dig through your situation, say, hey, if I was you, this is what I would do. So consult with a mortgage broker you like and trust. personalized guidance is what you're looking for to help you make an informed decision. Again, if you want to connect with us, greatmortgagebroker.com. Hopefully this was helpful. And until next time, we gonna see.